Hello everyone, welcome back to the channel. So in today's episode, I'll be delving deeper into whether or not the software sell-off is currently justified. So a lot of your software companies are down by quite a fair bit year to date because of AI fears. And I'll be delving deep into two companies here, Adobe as well as Salesforce. So over here it says software companies have been selling off quite a fair bit recently with names like Adobe down 11% year to date. The narrative now is that the stronger this AI wave gets, the weaker these software companies will become. A while back, software was touted as a winner with valuations high up in the 50s as well as in the 60s, and even in extreme scenarios like, for example, the trade desk, it traded all the way up to 120 times trailing earnings. So this goes to show that sentiment is always price driven, and software companies are currently the victims today. I'll be touching on two companies, namely Salesforce as well as Adobe. Salesforce will be in the first portion, Adobe will be in the second portion. So for Salesforce last year, they actually had a massive business revamp in terms of the model of the company, in terms of how they're planning to sell the software in the future. So for example, for Salesforce, so a key mode that a lot of people will try and link to for Salesforce is that the company has high switching costs because enterprises have data in Salesforce and they can't switch out of Salesforce because the cost itself to switch away from Salesforce is quite substantial. The time, the need to retrain staff is a lot more than what it costs to remain in Salesforce. So that's an argument that a lot of investors make. So we'll be covering whether or not that is valid in today's Salesforce. And over here it says Salesforce had a massive business revamp last year with major changes in how they charge enterprises for data storage, the trajectory of the business, as well as the lowered potential switching costs for the firm. So over here it says Salesforce used to charge enterprises for data storage. But what happened recently is that they introduced something called a zero copy partner network. So basically what this means is that enterprises will be able to use their Salesforce software to access data outside of Salesforce. What that also means is that Salesforce no longer houses a lot of the enterprise's software. So Salesforce has used this to create some sort of a tokenized economy. So they're tapping into this as well to create some sort of monetizable route for the company. But this change in the business model shows that customer is resistant towards increased monetization because they don't want to pay for data storage since they already have one elsewhere. And it also moves Salesforce towards usage-driven economics, which is much harder to defend as compared to some sort of an enterprise lock-in or subscription business model. So to further substantiate this point on a substantial business revamp, this is what Salesforce has been pushing over the past year, which is this thing here, Agentforce. So along with this is the extra focus on Agentforce. So Agentforce has become the main driver for growth for the firm, as well as a narrative support for Salesforce stock price, of course. So the bet now is that enterprises will stick to Agentforce. So currently we're seeing the narrative of agents coming up, agents increasing efficiency to reduce the need for human capital. This is what Salesforce is pushing as well. So they're betting on enterprises continually using Agentforce because Agentforce is better. And the longer the enterprises stick to Agentforce, the longer they can train their agents on this Agentforce portion, which will make the product even stickier for the firm. But there are a few caveats to the points that I just raised above. So number one is that this zero copy partner network actually lowers the Salesforce switching cost. So one of Salesforce's strongest moat has been the switching cost because data is embedded in Salesforce and it is hard to transfer the data out of Salesforce. But with this new partner network, what it means is that enterprises using Salesforce, they don't house the data in Salesforce. They house the data on an external sort of like data storage infrastructure platform, like for example, Snowflake. And if they're not super satisfied with this Salesforce platform, what they can simply do is to switch over to a competitor while still accessing the data externally because it is no longer stored in Salesforce. So with more leeway to access external data, this actually weakens Salesforce moat. Second of all, agents and the potential risk as well. So NVIDIA is creating workflows for companies to create their own agents. This will increase the demand for NVIDIA chips, of course. And there's this new thing over here, which is a non-profit organization, non-profit. It is this Agentic AI Foundation launched in December last year by OpenAI, Google, Microsoft, as well as AWS for non-profit, allowing enterprises to use and train their own open agents using compute powers from AWS, GCP, Azure. This is a potential headwind for the company. Why? Because it introduces a viable alternative that lowers the perceived value of the existing agents. So while the agents are still currently growing extremely strongly, this can be seen as sort of like a base effect, which is that the numbers are extremely small right now. That's why the growth numbers are very large. And over here, it also states that enterprises optimize for the best agents at the lowest risk-adjusted cost. And the introduction of open agent frameworks, which is this AAIF, introduces strong alternatives that weaken Salesforce pricing power and perceived differentiation, even if switching remains unlikely. So what this means is that Salesforce will have less authority to increase prices because there is a viable alternative. So Salesforce is reasonably priced today for single-digit to low teens free cash flow growth with higher risk, and it is not necessarily undervalued. I think the firm is currently trading at 22 times stock-based comp adjusted price to free cash flow, which is historically on the lower side. The downside to the firm is currently protected by stickiness in terms of the recurring streams of revenue coming into the business, 5 to 6% growth for the existing legacy business, but the upside is also weakened with the reduced ability to increase prices, especially if they're going down this route of Agentforce, where the growth is 100% supported by Agentforce. So I think for Salesforce today, it's a company that is probably in the too hard pile. Valuation looks attractive in the broader markets today, but this is probably an avoid for me. The next company that I'll be diving into is Adobe. So Adobe products are extremely sticky for enterprises. I use their products as well. And there are grounds to argue that enterprises will always use Adobe for full control and for finishing touches of editing as well as design work and all your other different creative work as well. But there are two prominent bear theses for Adobe today. Number one is competition. Second of all is AI advancements. So in terms of competition, you have three different companies. You have Adobe, you have Canva, you have Figma. Figma is more focused on UI UX, so it's not 100% overlap with Adobe, although there are some segments of overlap in terms of Illustrator as well as Figma's version of it. Canva is targeted towards low-end consumers, so their average revenue per user is substantially lower as compared to Adobe. Adobe targets more of enterprises. Majority of their customers come from enterprises as well as creative professionals. For Canva, it's more user-friendly and more consumer-driven. The second form of competition, which I think is the more substantial one, is actually the AI risk for the firm. So over here it says, according to McKinsey's 2024 research on AI and productivity, designers and marketers using generative AI tools reported a 30 to 40% reduction in time spent on routine tasks like asset resizing and so on. So Adobe's internal study on Sensei claimed up to 25% reduction in iteration cycles when designers use automated layout suggestions and so on. So the data above suggests that there is increased productivity when it comes to AI. But the problem with that is we don't know whether this increased productivity is in Adobe or outside of Adobe. And we'll have to track the engagement numbers for Adobe itself. They don't really release it, but there's a way to track it. You can use a proxy. Because if they're not capturing the productivity inside their platform itself, what they will risk is the erosion of the business itself. Because what this means is that more existing users will actually use external platforms. So what Adobe is actually trying to do now is, number one, they're trying to integrate external models into their own ecosystem to reduce switching costs and improve convenience. Second of all is that they're allowing companies to use Adobe's AI. So they have this Firefly, they have this Adobe Foundry as well for generative AI, which is for Firefly, and for training of the AI on the enterprise's internal proprietary photos as well as videos, which is this Adobe Foundry. So the idea is this: if let's say I got a big firm, I have a lot of different creative assets, what I can do is I can plug it into this thing called Adobe Foundry. This is what the enterprises can do to try and train the Adobe AI to create content assets for the firm. So the argument here is that this increases switching cost for all these different enterprises using these two things here. So while integration improves convenience, it weakens Adobe as an AI player because it potentially weakens the perceived value for lower-end consumers. So low-end users may start questioning the need to pay for Adobe services with increased reliance on external models within Adobe. So for example, Adobe is currently integrating all the different image generation tools on their own platform, like for example, Nano Banana. And the inclusion of external models is also an admission that the company's models are simply not good enough. that they will require external models to try and gain more traction. So as for Firefly as well as Adobe Foundry, the key selling point for the firm today is that it is commercially safe, which is compulsory for your Fortune 500 companies because they can't use those ads if they're not commercially safe. So this provides enterprises with security compared to other models like Runway and Flux, serving as a guarantee for enterprises. So there's actually a minor bull thesis for the company today. This is the main argument by bulls, which is that your images generated by Firefly are commercially safe. And what this means is that enterprises will stick to Adobe even more. So that leads to the next question of whether or not Adobe's user base is primarily enterprise-driven or consumer-driven. Based on their own internal report and based on this graph here that they released, it's around 15 to 20% consumer-driven and around 80% enterprise and professionals-driven. What this means is that majority of the company's earnings and cash flows actually comes from enterprises. So this serves as sort of like a flaw for the firm. This is a semi-bull thesis. So another key thing to note for Adobe is this. The revenue growth in the recent years has basically matched the pricing growth for the firm. And what that means is that the company is no longer growing volumes. So normally for a firm, there are two things that you need to evaluate. Number one is short-term economics, and short-term economics normally come from price cuts, from some form of margin expansion, from optimization and efficiency growth. But in the long term, companies grow because the market expands. So over here it says long-term economics depend on the total size and breadth of the market that the company can expand into. In the case of Adobe, this is currently a question mark because volume is no longer increasing. As for the bull theses, there are a few considerations to make over here. So I've highlighted a few common bull theses. First one is AI-driven growth. The company is reporting strong AI-driven growth numbers. And Business Professional, for example, is actually growing faster than the rest of Adobe. And it is the portion of the business that has the most AI integrations. The introduction of new AI economy with credits for features like generative fill enhances stickiness for the higher tier subscription. So this thing over here, generative fill, is something that is quite important for a lot of the users. And what they've done is instead of offering it for free, they have monetized it. So they have introduced something called a credit economy, similar to Salesforce, where you have to pay to use that thing, the feature. But of course, it is bundled into the subscription as well. So if you have a higher tier subscription, you will have higher credits, so you don't really have to pay. So what they're trying to do is to push their existing subscriber base towards those higher tier subscriptions. Second bull thesis for the firm is increased productivity may lead to lower cost for production for all these different content assets, leading to greater demand. This is actually called Jevons paradox. So let me try and explain Jevons paradox. It is the idea that increased efficiency will lead to increased demand because when your efficiency is higher, what happens is the cost itself is actually lower. So when the cost is lower, what happens is people will start piling in. There will be incremental demand for this product and it becomes sort of like a commoditized thing. What this means is that brands will be able to save costs because AI is making a lot of stuff a lot easier and pull it into producing much more high-end content, which is accretive for Adobe. The third strong thesis is that the remaining performance obligations for Adobe is still strong, so it signals near-term growth for the firm. Last one is that the stock is cheap. So it is currently trading at an 18 times PE ratio compared to the broader markets. Adobe is actually trading at a much cheaper price. So this is a one-liner summary for Adobe today. So all in all, my biases leans towards this being in the too hard pile, similar to Salesforce. While the company is cheap, Adobe's challenge is AI uncertainty capping multiple expansion. With this AI narrative continually haunting Adobe, the multiple can't expand. And for Adobe, there's limited growth re-acceleration as well because the entire growth of the firm today is actually driven by pricing. So for Adobe, while the downside may be limited, similar to Salesforce, by enterprise lock-in as well as remaining performance obligations, upside is entirely dependent on AI-led demand expansion, which is what we discussed earlier, your Jevons paradox, and what the company is doing to integrate AI into the entire platform and to basically turn those models into commodities and create some form of a workflow mode for the company. So for Adobe today as well as Salesforce, I think these two companies are in the too hard pile. I know they're cheaper than the markets today, but that doesn't necessarily mean that you should be betting on it. Of course, that's unless you see something that the markets are not seeing today. This is a bit different from Google. Google's economics were largely unaffected by AI. In the case of Adobe, there may be strong weaknesses when it comes to AI. Second of all, Google had a price floor simply because of the sum of the parts as well as the other businesses driving up and pushing up and supporting the growth of the firm. In the case of Adobe, it is almost 100% reliant on their creative cloud. It's around 78% of the entire business. So we'll see how this one plays out, but for now, these two companies are avoids for me. I hope you guys have found this video useful, and I'll see you guys soon.